Hey everyone, this is Ryan B with Practical FX Trading. This is your Euro Great British Pound weekly analysis for the week of January 5th, 2020. Make sure to subscribe to our channel if you'd like updates on all of our Euro Pound videos, plus all of our other currency pairs. We also do Bitcoin, Brent crude oil analysis, so subscribe to our channel and be the first to know when we release our new videos, typically every Sunday. We also have some how-to videos that come out sporadically, so you'll be the first to know about those. This is a weekly chart of the Euro Pound. This shows it goes all the way back to 2004, but I really just wanted to show you here where price is at this big resistance zone at this 86 mark, this 0.86 mark. So we see last week, and we'll go ahead and zoom in, that 2 weeks ago we saw a huge bullish spike up to 87, touching the 20-week moving average but not exceeding it. We see price, even after touching it, still traveling below. So that's pretty significant. We see that happen before. We see price really fall off. Also, after trying to make a new high, it did make a new high at 94, but then quickly was pushed away. So I'm looking to be bearish in this one. It's kind of bearish in the euro in general against most pairs, euro pound being no exception. So let's go ahead and zoom in now. We see that price really failed to hold, and actually last week price went ahead and made this big drop down before being bought up by short-term traders from the 84. Let's go ahead and look at the daily chart. Now we do see that price moved above the 20-period fast-moving average in the daily. That's fairly bullish, and this looks kind of like a bullish short-term formation. However, I'd need to see price move above this 87.22 mark for me to be convinced that this is back on the bull trend. So it really depends. You're either bearish or bullish. You have to decide for yourself which way your trade is going to be. And there's nothing wrong with playing both sides. You can make money either way. You just can't make money off of both at the same time in the same account. So you have to decide what you're going to do. So if I'm selling, I'm going to take these recent highs and connect them. And it's okay. This doesn't have to be exact. See how this one kind of falls short, and then this one touches exactly, that one touches exactly. Or you could also take this and drag it down and just put it above the body of where the candles close. And these tails they call it, right, are just kind of like, it was like an extreme market day, a lot of action. But even though that it's usually a geopolitical event that triggers it, just because that happened, it doesn't change the overall trend. It's just a short-term blip. Forex doesn't move in straight lines. That always needs to zig and zag. So the zigs and the zags are usually market data or a geopolitical event that made a big trigger happen, and then once the market kind of gets used to it, it fades back off. So we see here, so these last three daily candles, these are fairly bullish, right? It's kind of like three black crows. It's a candlestick formation. However, it did not close above this giant bearish candle. The body did not exceed this 85.50. So really, it's still potentially bearish, right? So we're going to need to see this rally continue, like I said, and push above this line. Now, what could happen is price could test it again and fall back away, still be in the downtrend. So if we look at some shorter-term resistance, here's another layer. See how price moved along this 85.80 for quite a few days, then fell below that. One man's ceiling is another man's floor. So tested as a floor, fell below, tested as a ceiling, tested, keeps getting pushed away. Even if it makes another attempt, there's a good chance we can see a further decline. So let's go ahead and draw a parallel trend channel. Let's go ahead and zoom into the 4-hour. Alright, so parallel trend channel just helps me get a better feeling of what's a mirror trend to the big one that's a little bit more relevant to a shorter time frame. So yes, maybe I want to day trade, but yeah, I still want to look for my best selling opportunities because I believe that's where the big money's at. So a parallel trend channel shows me support and resistance on a trend scale, a trend angle. The most important thing is you try to get these angles identical. Some tools have a great like trend channel tool which will draw parallels perfectly. So I need to look into getting something like that. But if I do this parallel trend channel, then this kind of tells a story, right? These candles kind of like touch this line, keep getting pushed away, which means this might be a great sell. A lot of the euro pairs are looking as a great sell as we go into this week. And I put my stop above, well, 85.87, right? So I can sell this 85.20, about 50-60 pips I can put price here. It's not ideal. If I want to be conservative, like super conservative, I'm going to put my stop above this last high in the hour at least. Let's go ahead and look what that is. Yeah, maybe I just want to sell at 85.25 and put my stop here, tuck it up to 85.52 or so, and look to test the last low, right? So this is pretty bearish. However, it's a little bit of an, this kind of weird uptrend. We had New Year's Day, so that made for some weird candles. But we look, and Friday this was tested and getting pushed back down. So if I'm currently bearish on this. I'll be looking to sell, put my stops above that last high, or at least this zone here. Maybe I don't want to put above this high because I really don't want to be stuck in a negative position. To be honest, I don't want to be looking at something in my account that's like negative 100 because I believe it's going to come back. That's a real dangerous way to trade. Instead, I'd rather sell in the short term, put my stops, and then as price declines, I can go ahead and keep tucking them up. Right? Because don't forget, once you're like ahead, let's say you set your stop loss here, and make a red stop. Sorry, red line for stops. Let's say I start with my stop loss up here. As price declines, let's say it makes a new low of 84.20. I got in here, I can go ahead and move my stop loss up at 0 pips, meaning even if price came all the way back and clipped me out, I still wouldn't lose any money. And that's easy living, right? I mean, if you can just hold on to your positions and not worry about them hitting your stops, that's a pretty good way to go. A lot of times most traders are on the other end of the spectrum saying, like, grinding their teeth wondering if price is going to hit their stops. If you can get a great entry, so right at the right spot, you set your trade out and you keep bringing up that stop loss as it moves down. You keep manually skidding it forward a few pips at a time. You can make some great gains, right? So cut your losses short and let your profits run. Okay, so have a great week trading. Talk soon.